Hey everyone, it's Vikash, and welcome back to the channel. Today we're diving deep into the world of trading, mastering the art of support and resistance. These are the very building blocks of technical analysis, and understanding how to use them can be a game changer for your portfolio. We'll be covering 8 powerful techniques, breaking them down step by step, so you can start implementing them in your own trading strategy. So, buckle up, grab your notebooks, and let's get started. Alright, let's kick things off with the breakout strategy. This one's all about capitalizing on those big price swings when a stock breaks through a key support or resistance level. Imagine this. You've been watching a stock and it's been bouncing between a support level of $50 and a resistance level of $55 for a few weeks now. Now, the breakout strategy comes into play when the stock finally breaks free from that range. Let's say it surges past $55 with strong volume. That, my friends, is a breakout. And it's a signal that the buyers are in control and the price could be headed higher. So, how do you trade it? With a breakout to the upside, you would look to buy the stock slightly above that $55 resistance level. Why above? Because we want to see confirmation that the breakout is real and not just a false alarm. On the flip side, if the stock breaks down below that $50 support level with strong volume, that's a bearish breakout, and you might consider shorting the stock or buying put options. The key here is volume. A breakout with high volume is like a rocket launch. It tells you there's real power behind the move. But remember, not all breakouts are created equal. You want to look for breakouts that are confirmed by other indicators. For example, you might see a surge in volume, a positive candlestick pattern, or even a move above a key moving average. Trading breakouts can be exciting because you're riding the momentum of the market. It's like catching a wave at just the right moment, propelling you forward with the market's energy. However, it's crucial to stay vigilant and manage your risk. Not every breakout will lead to a significant move, and some may even reverse quickly. Setting stop-loss orders can help protect your capital in case the trade goes against you. Also, keep an eye on market news and events, as they can influence the strength and direction of breakouts. With the right strategy and careful analysis, riding the wave of momentum can be a rewarding experience in the world of trading. The bounce strategy is all about, you guessed it, those bounces. It's a popular method among traders who love to capitalize on predictable price movements. Specifically, we're looking for bounces off those key support and resistance levels. These levels are crucial as they often indicate where the price will reverse direction. Think of it like a tennis ball bouncing off a wall. The ball hits the wall and then rebounds, just like how stock prices react at these levels. Support acts as the floor, preventing the price from falling further, while resistance acts as the ceiling, stopping it from going higher. These levels are like invisible barriers in the market. This strategy is all about identifying those levels where the price is likely to reverse. Recognizing these points can give you a significant edge in trading. So let's say a stock you're watching has a strong support level at $50. This means that historically the price has struggled to go below this point. Every time the price drops near that $50 mark, buyers seem to step in, and the price bounces back up. This repeated behavior makes it a reliable level to watch. Now that $50 level becomes a prime opportunity for a bounce trade. Traders look for these opportunities to buy low and sell high. You could consider buying the stock near that support level with the expectation that it will bounce back up. This can be a profitable move if timed correctly. Of course, you want to look for confirmation before jumping in. Confirmation signals can include volume spikes or specific candlestick patterns. Look for levels that have been tested multiple times in the past, as these are more likely to act as significant turning points in the future. The more a level is tested, the stronger it becomes. The retest strategy is all about capitalizing on what happens after a breakout. After a stock breaks through a key support or resistance level, it often comes back to test that level again. This retest is a powerful opportunity for traders because it provides a second chance to get in on the move. Let's say a stock breaks out above a resistance level of $60. You might have missed that initial breakout, but don't worry, because the retest strategy gives you another shot. As the price pulls back to retest that $60 level, you would look for signs that it's going to hold as new support. This could be a bounce off the $60 level with increasing volume or a bullish candlestick pattern. If the retest is successful and the $60 level holds as support, it's a strong signal that the buyers are still in control. By waiting for that retest, you're essentially letting the market show you its hand and confirm the direction of the trend. The trend continuation strategy is all about identifying and trading with the prevailing trend. It's based on the idea that the trend is your friend, and by using support and resistance levels, you can ride those trends for bigger profits. In an uptrend, support levels act like stepping stones, pushing the price higher. The price might pull back to a support level, but as long as that level holds, the uptrend remains intact. Conversely, in a downtrend, resistance levels act like roadblocks, preventing the price from moving higher. The price might rally up to a resistance level, but as long as that level holds, the downtrend remains intact. The key to this strategy is to identify the trend early on, and then use support and resistance levels to time your entries and exits. You want to buy near support in an uptrend and sell or short near resistance in a downtrend. Multiple time frame analysis, or MTFA, is like putting on your trader's magnifying glass. It's about analyzing support and resistance levels across different time frames to get a clearer picture of what's really going on in the market. A support or resistance level that looks significant on a 15-minute chart might not be as important when you zoom out to a daily or weekly chart. And vice versa, a level that seems insignificant on a daily chart might actually be a major turning point on a lower time frame. So how do you use MTFA effectively? Let's say you're looking at a stock on a daily chart and you identify a strong support level. Now you can zoom into a lower time frame, like a 4-hour or 1-hour chart, to pinpoint a more precise entry point for your trade. MTFA allows you to filter out the noise and focus on the levels that truly matter. The Fibonacci retracement tool is like having a secret weapon in your trading arsenal, providing insights that are not immediately obvious. It's based on a mathematical sequence discovered by Leonardo Fibonacci, a brilliant mathematician from the 13th century. This sequence is used to identify potential support and resistance levels based on the golden ratio, a concept that appears frequently in nature and art. Here's how it works. You take two extreme points on a chart, usually a significant high and a significant low, and then draw the Fibonacci retracement tool between those 2 points. This helps in visualizing potential areas where the price might retrace before continuing in the original direction. This will create a series of horizontal lines at specific Fibonacci levels, the most common being 23.6%, 38.2%, 50%, 61.8%, and 100%. These levels are crucial for traders. These Fibonacci levels often act as hidden support and resistance levels, which can be pivotal in making trading decisions. Traders use these levels to identify potential reversal points, set profit targets, and place stop-loss orders. This strategic use of Fibonacci levels can significantly enhance trading performance. For example, let's say a stock has rallied from $50 to $100. This kind of movement is often analyzed using Fibonacci levels to predict future price action. You can draw the Fibonacci retracement tool from that $50 low to the $100 high. This helps in identifying key levels where the price might find support or resistance. If the price bounces off that level with confirmation, it could be a good opportunity to enter a long position. This method provides a structured approach to trading, making it easier to anticipate market movements. Volume profile is like having a backstage pass to the market's inner workings. It's a powerful tool that allows you to see where the real buying and selling pressure is happening at different price levels. Volume tells a story. It reveals the conviction behind price movements. High volume indicates strong interest and participation, while low volume suggests indecision or lack of conviction. The volume profile takes this a step further by showing you the volume traded at each price level over a specific period of time. It's typically displayed as a histogram on the side of your chart, with the horizontal bars representing the volume traded at each price level. The key to using volume profile is to identify the high volume nodes. These are the price levels where the most volume has been traded. High volume nodes often act as significant support and resistance levels. This could be a good indication that the support level is likely to hold, and it could be a good opportunity to buy the stock. The confluence strategy is all about combining the power of multiple indicators to strengthen your trading setups. It's based on the idea that two heads are better than one. And by combining different pieces of information, you can increase your odds of success. When it comes to support and resistance, confluence occurs when multiple indicators point to the same level. For example, you might find that a key support level lines up with a Fibonacci retracement level, a moving average, and a previous swing low. This confluence of indicators creates a high probability trading zone. The more indicators that align at a particular level, the stronger that level becomes. It's like having multiple layers of support or resistance, making it more difficult for the price to break through. If you find confluence from multiple indicators, it strengthens your conviction that the support level is likely to hold. This could be a good opportunity to buy the stock. So there you have it, 8 powerful trading strategies that utilize support and resistance. Now, it's one thing to understand these strategies in theory, but it's another thing entirely to apply them successfully in the real world. Remember, effective trading requires practice and risk management. Use demo accounts to hone your skills and always set stop-loss orders to protect against unexpected moves. Trade smart, stay disciplined, and never stop learning. Thanks for watching, and I'll see you in the next video.